What's going on, everybody? My name is Ryan, and today I want to chat a little bit about the capital gains tax and how you can avoid and defer the capital gains tax. So first thing you might be asking is, what is capital gains? You heard of this before probably, but really what is it? It's when you sell an assets for more than what you bought it for, essentially. There's some other things that could adjust, the number that you bought it for, but that's not for this video. That's gonna go into more detail for some other time. So to keep it simple this week, let's say capital gains is when you sell an asset for more than what you bought it for. Now this could be any asset. Surprisingly, you might think that it only applies to stocks and houses, which are really the most common things that you might see as appreciating assets. But this could also be applied to cars, watches, collectibles, art. Anything that you buy that you sell for more than you bought it for would be a capital gain. Now you're thinking like cars, what? I never reported my car on my tax return. Well, that's because you sold it for probably less than you bought it for. It's usually a depreciating asset. But because of all the COVID stuff going on the past few years, you might see some cars that you might be able to sell for more than you bought it for. That might be selling for over retail. So just something to keep in mind, that if you do sell anything for more than what you bought it for, it should be reported on the tax return. Now, there are two types of capital gains. There's a short-term and a long-term capital gain. Short-term capital gains is when you purchase an asset and you held onto it for less than a year before you sold it. That results in a short-term capital gain. This is taxed at ordinary tax rates. So the same kind of tax rates that you would be taxed at when you are working a W-2 job, for example. So not great, okay? Long-term capital gain is more favorable because it has a more advantaged tax rate. So these are when you hold an asset for a year or longer. Long-term capital gains rates for most people is at 15% federal, all right? And if you make a lot of money, like $600K a year or more, then this tax rate goes up to 20% capital gains rate, plus net investment income tax for you rich folks. You have to pay an extra 3.8% just because why not, right? So keep that in mind. If you can hold an asset for longer than a year, you're going to be in a much better tax position. Now, there are two very common ways that people use to defer capital gains. Now, what does defer mean? That means that if you sell an asset for more than you bought it for, if you defer that gain, you don't have to recognize that gain the year that you sold it. You might recognize it at a later date, depending on what you do with it. But it could be a good strategy for you if you're about to realize a ton of capital gains. So the two methods are, first, a 1031 exchange, and second are opportunity zone investments. Let's talk about the 1031 exchange first. So the 1031 exchange is only valid for real property, which means like houses or commercial buildings, like real estate. Okay, this has changed somewhat recently, probably a couple decades ago, but you used to be able to basically do a like-kind exchange for any asset. You buy a stock and you exchange it for another stock, and you can defer the capital gains. Well, the IRS kind of got rid of that rule, and they are only allowing it for real estate. How does the 1031 exchange work? The very basic process is you have a house, an investment property. It's not your personal house, but it's a house that you have either as a rental or as an investment, and you want to sell the house. Okay, if you're about to recognize the capital gains, you then basically identify a new house and then purchase the new house after you sell the first house. In this way, what this does is you're basically exchanging one property for another property. Now the new property has to be a business property. It has to be a property that you're using as an investment. It can't be a personal residence. Okay, so that's the very simple process. I'm not going to go into all the details because you have to do the purchase of the new house and the identifying of the new house within certain time frames in order for this to qualify. And the most important thing to remember is, in order for you to even qualify for the 1031 exchange, you have to go through what's called a qualified intermediary, which is a person or a company that is licensed to facilitate these 1031 exchanges. Okay? You can't just go on your own and say, hey, I'm going to sell this property and I'm going to buy this property and I just did a 1031 exchange. No, it doesn't work that way. You have to engage with a 1031 exchange qualified intermediary first, so that they will facilitate where the money goes from the sale of your first property and then purchasing the new property. Now, in order to fully defer all of your capital gains from your old property, you have to identify and purchase another property that is an equal or greater value than your first property. Okay, if you can choose to purchase in a new asset that is a lesser value, but then you're going to be realizing partial capital gains because not all of the money from your old property got transferred into your new property. Another thing that people can do is you can sell one property and purchase 2 or 3 new properties. As long as they total equal or greater value, you're going to defer your entire capital gains by doing it that way as well. There's also something called a reverse 1031, which is when you identify and purchase a new property before you sell your first property, and that is something that can happen. Now keep in mind, when you do a 1031 exchange, you're only deferring capital gains. You're not avoiding it. Okay, that means at some point you might want to sell your investment property. That's when you're gonna have to realize any capital gains at that point. The only way to fully avoid capital gains without selling your property is to hold on to any of your assets until you die. And that way, obviously when you're dead, you don't have to file taxes anymore, which is a huge benefit, right? But also your heirs, whoever inherits your property, gets a step up in their basis so that if they do sell the property, they don't have to realize any capital gains. All right, so the next common thing that people do to defer capital gains is investing in opportunity zone funds. Now, opportunity zones are zones or areas in the US identified by the IRS as areas that they want to develop, that they want to incentivize people to invest in and develop to better the community. By way of incentivizing this, they will allow you to defer any realized capital gains that you may have incurred by taking the money that you gains from the sale of an asset and investing in qualified opportunity zone funds. Now, you better talk to your financial advisor to see what funds qualify as opportunity zones. If you don't have anybody, reach out to me and I can give you some great contacts. But either way, this is another way. It's kind of like doing a 1031 exchange. It's not as structured. It's not restricted to real estate. Okay, so you can defer any kind of gains this way. Basically, what happens is if you have any events, like you sell a house for capital gains, and you want to defer that gains without doing the 1031 exchange, or maybe you forgot to get in touch with a qualified intermediary, or you want to get out of real estate altogether, then what you can do is within 180 days of selling that property, you can go and invest in an opportunity zone fund, and the amount of money that you invest in there is basically the amount of gains that you will defer. And you will defer those gains until you sell your investments in the opportunity zone, and at that time, that's when you're going to realize all the gains. So this can be done strategically, right? So let's say you're going to have a gain of like a capital gains of $1 million, and you invest $1 million in opportunity zone funds. Well, then you can slowly trickle the capital gains that you realize each year, so you don't have to pay a heavy tax on it. You can get a more favorable tax rate. You can defer until maybe the rest of your other income decreases, so you're not at a higher tax bracket. There's a lot of planning opportunity here. So something to keep in mind: 1031 exchanges and opportunity zone funds. And that's all I got for today. Again, my name is Ryan. Please subscribe to my channel if you find this video helpful. Returning viewers, welcome again. Thank you for supporting me, and I'll see y'all next week.